Good afternoon. Welcome to the New America Foundation. I'm Michael Dannenberg, our Education Policy Program Director. My apologies for our late start this afternoon, but we'll try and get moving quickly. To most, student loans are a wholesome government program like Head Start, Mom and Apple Pie, helping millions of kids go to college each year. But there's another story behind student loans, which is that there are some very clever people who provide student loans who have made a great deal of money on this system. To most student loan borrowers, they only look at one interest rate, and that's the interest rate that they pay. But it's important to keep in mind that there are two interest rates in the student loan program. There is the rate that student borrowers pay, the borrower rate. There's also an interest rate at which lenders are guaranteed, the lender interest rate. And when the borrower interest rate is beneath the lender interest rate, the government provides a subsidy to lenders to make up the gap. It's called a special allowance payment. Congress writes into law these interest rates. They write into law the borrower interest rate, and they write into law what the lender guaranteed rate of return will be. That is a guaranteed rate of return on top of a guarantee against default. We're going to discuss two inefficiencies in the system today. One is a very specific inefficiency with respect to the lender interest rate that's set. In 1980, Congress attempted to set an interest rate for a special subclass of student loans at 9.5%. Actually, it was higher than 9.5%. 9.5% was a floor, a bare minimum that lenders could be guaranteed to receive in 1980 when interest rates were much higher. But in 1993, the rate was still 9.5% for this special class of loans, and interest rates had gone down. Congress thought it got rid of the interest rate. In fact, it continued on for years to this day. There are lenders who still have a subclass of loans on which they're getting a 9.5% guaranteed rate of return. This is for new student loans that have been newly issued. As late as last year, 2 years ago, 2004, when the student interest rate was 3.5%, the lenders were being guaranteed a rate of 9.5% for this special class of student loans, hence the inefficiency. The 9.5% guarantee is for a special class of loans. In general, lenders are guaranteed an interest rate which is lower. It's equal to the rate for commercial paper as it's publicly traded, plus 2.34%. But even that rate of interest provides lenders a significant rate of profit. Be they for-profit lenders and nonprofit lenders turn those quote-unquote profits back into student services in some way, shape, or form. Our first speaker is going to discuss that first interest rate, the 9.5%, the special interest rate, which people thought, members in Congress thought they got rid of long ago, but never seemed to go away. Our second speaker is going to speak to, in general, the student loan subsidy rates, what happens with the money that lenders get, what they do with it, whether it is or is not in the best interest, and he'll discuss his own company. Our third speaker will respond to these two, to the presentations of these two, and basically offer questions. Our three speakers. First is John Oberg. John Oberg is the hitherto unidentified whistleblower, insider, who has worked for the Department of Education for 10 years, prior to that for Congress, who first identified this 9.5% subsidy that was continuing on into the early part of this decade. He is the former legislative director to Senator Jim Exon of Nebraska. John is from Nebraska. He is also the former chief fiscal officer for the state of Nebraska. He is a PhD from, I believe, the University of Berlin, and also a retired naval officer. Next to John is Raza Khan, who's an exceptionally impressive young man. Raza is less than 30 years old. He started a maverick, what I call a maverick student loan company, a very small student loan provider called My Rich Uncle, myrichuncle.com. And for those who are interested, My Rich Uncle sort of made a splash in the higher education community this summer because they put out a series of two-page ads in the New York Times, USA Today, and so forth, accusing colleges of receiving kickbacks and payola for funneling student loan business the way of certain lenders. My Rich Uncle does not provide these rewards to colleges, presumably, and has also used its excess subsidy money that the government provides to lenders to lower interest rates for student borrowers. Finally, our third speaker, Doug Lederman, L-E-D-E-R-M-A-N. I hope I pronounced that correctly, Doug. Doug is the co-founder and editor of a publication called Inside Higher Ed. It's a trade publication available online, www.insidehighered.com. It is free. Doug is the former is a former editor and has 20 years of experience in education journalism, specifically as the managing editor of the Chronicle of Higher Education, which, although a great publication, is not free. Inside Higher Ed has received over 400,000 hits in the last 30 days and has become, in a very short period of time, having been around only a year and a half, an influential publication in the education trade industry. Please join me in welcoming our first speaker, John Oberg, retired from the Department of Education. Thank you.
Thank you, Michael. Sorry you had to wait a little bit for us to get underway. I'll keep my remarks as brief as I can. By the way, it was the bureaucrat, myself, who was on time. The entrepreneur was the one who was late. He was out making money. Michael, thanks for inviting me here to the New America Foundation. I have, of course, been at many venues around DuPont Circle, but not to the foundation here, and thank you so much for the invitation and the opportunity to speak a little bit on this subject. Before I talk too much about 9.5% guaranteed student loan interest, let me quickly remark on 4 reports that have recently been published, which are of great interest, and I'd like to try to tie in this subject today a little bit to these reports. First is the OECD report, which came out a couple of weeks ago, that said that American higher education was falling behind some other countries in its leadership position in the world. A second report that has come out within recent days is a College Board report by Sandy Baum and Lucy Lipovsky that documents the shift in aid away from financially needy students to merit-based aid. A fourth report is a report of the Pat Callan Group, the National Center for Public Policy in Higher Education, which documents the status of many efforts that are going on in higher education in the states and gives a report card. And then the fourth one, which the draft has been widely circulated, but the final report is not out yet, and that is the Secretary's Commission on the Future of Higher Education. Now, each of these reports talks about problems in U.S. higher education. I believe the Secretary's Commission is going to talk about the student financial aid system and how it is dysfunctional. Several of the reports point to a lack of good research in American higher education and a lack of knowledge about exactly what is wrong, let alone exactly what we ought to be doing about it. In the Secretary's report, this lack of information has resulted in a very controversial proposal, and that is that the country should establish a so-called unit record to start tracking students to find out what is going on in our system. During my comments today about 9.5 loans, I may describe several documents I have reviewed at the department or have in my possession. I would be eager to provide these documents to anyone here were it not for the fact that when I left the department about a year ago, I was required to sign papers to the effect that I would not release internal documents. Some of these documents may be covered by that requirement. Although I believe this limitation may be a violation of the Lloyd-La Follette Act, which protects the right of federal employees to share documents with Congress, you are not Congress, so I will avoid this problem by not sharing any documents with you today. If you are interested, you should be able to FOIA them and get them through congressional channel, or get them through congressional channels. I have to begin this tale in 1998, when I was the department's liaison to the Congress for the reauthorization of the Higher Education Act. I literally carried legislation to the Hill that repealed all provisions relating to pre-1993 student loans funded by tax-exempt bonds on which federal taxpayers guaranteed loan holders a 9.5% return. That is, as Michael explained to you, taxpayers paid the difference between what the student borrower paid and 9.5%. This was part of an effort by the department in the late 1990s to eliminate these payments as soon as possible, which Congress thought it had cut off in 1993. Unfortunately, the House did not want to enact this recommendation. In the spring of 2003, I began asking a few of my department colleagues what was happening to the amounts of pre-1993 9.5% loans still outstanding, because interest rates to students in 2003 had fallen to about 3 or 3.5%. That meant taxpayers must be subsidizing the loan holders an additional 6 or 6.5%, a remarkable total rate of return for the times. I was interested in how fast the approximately $12 billion loan volume of these old outstanding loans was declining, who held the loans, on what the excess proceeds above the other loans were being spent, if arbitrage rules required return of the excess proceeds to the Treasury, and whether the department was keeping track of the program as required to do so under the Government Performance and Results Act, GEPRA. No one at the department seemed to know the answer to any of these questions, so I began looking at the financial reports of student loan secondary markets, that is, the bankers, so to speak, the most likely holders of such loans. I was surprised by what I found, which appeared to be irregularities. Some secondary markets, like New Mexico's, seem to be issuing new tax-exempt bonds to fund 9.5% guaranteed loans long past Congress's 1993 cutoff. Others were increasing their 9.5 holdings substantially. After discussing these irregularities with colleagues who were likewise puzzled, I notified the Inspector General on August 7, 2003, under an OIG circular which encourages employees, a civil servant employee, which I was, to report instances where waste, fraud, abuse, or mismanagement appear to be involved in department programs. While awaiting a reply, in September of 2003, I asked the secondary market the process by which they had increased their 9.5% holdings by several $100 million, and if they were using the proceeds for financially needy students. They replied that their secondary market trade association, the Education Finance Council, had advised them that a Department of Education 1992 regulation, when read in conjunction with a 1996 sub-regulatory letter, Q&A Item 30, permitted the growth. They indicated that the department was paying their claims without question, but replied that they had no way of knowing how much of the money was going to financially needy students, as no one had asked. I looked at this rationale for the growth in the outstanding amounts of these loans, and I could not believe it. Let me illustrate it here with a simple analogy. It is as if secondary markets and their trade association advanced an argument that the letters GHOTI spell the word fish. If you take GH from enough, O from women, and TI from vacation, it spells fish. So too, if you take a 1992 Department regulation on tax-exempt bonds, ignore, like a silent letter, the 1993 statute repealing the 9.5% program, and exhume a 1996 Q&A attachment written in a different context, you will get an argument for increasing 9.5 loans from the old level of $12 billion and declining to a new level of $18 billion and increasing. GHOTI spells fish. In November of 2003, I wrote a follow-up to the Inspector General noting that Nelnet, a large for-profit student loan secondary market, was rapidly increasing its holdings of 9.5 loans, and that if all such secondary markets were creating these new obligations, there could be huge consequences for taxpayers. In November 2003, in addition to bringing Nelnet irregularities to the attention of the Inspector General, I also wrote a memorandum to the Department through the chain of command, starting with the Director of the Institute of Education Sciences, Russ Whitehurst, where I worked and where my duties included post-secondary finance research. In that 2003 memorandum, I urged the Department to end the practice of guaranteeing 9.5% on student loans that were a result of 9.5 loan volume, as this growth had not been approved by the Department. There are several documents at the Department attesting to this fact, and was based at that point on a recent self-interested interpretation by a trade association of an obscure attachment to an 8-year-old sub-regulatory letter signed by a Deputy Assistant Secretary. I noted that Nelnet itself, in a 2003 U.S. News and World Report cover story on student loan abuses, acknowledged that the 9.5 payments were wasteful. I estimated in my memorandum that the waste was approximately $30,000 a day, a figure that would greatly multiply, I feared, if the Department did not act to clarify its 1996 attachment on which the whole 9.5 growth scheme was based. The email reply I got from the Director of IES indicated that he would forward the memorandum to the appropriate officials responsible, but he also notified me that my research responsibilities would be rewritten so as to preclude my further research into this issue without prior approval. I was never notified whether my memorandum went forward or not, but my duties were rewritten, and indeed my research into 9.5% growth on Department of Education time came to an end. Russ Whitehurst is a psychologist. He should know that if you tell some people they can't do something, they want to do it all the more. I contacted my department's Office of Ethics and asked if there was any reason I could not continue the research on my own time with my home computer and take my findings on my own time to the Government Accountability Office. The answer was yes, I could continue the research on my own time and meet on my own time with GAO. In January 2004, I contacted GAO as a citizen and taxpayer. Taking leave from the Department of Education, I met with GAO in February of that year to give them my analysis of the memorandum I had previously written to the department's chain of command. In April 2004, I received an email from a regional IG auditor in Minnesota asking me for more information about 9.5 growth, specifically the financial mechanisms under which the growth was taking place. I described for him what I suspected was a two-step process, transferring old loans to new bond issues, then recycling the proceeds of the transfers into new loans under the old bonds, essentially growing the 9.5 loans outstanding by the amount of the transfers. I noted that this process seemed to be new, starting in about 2002, but it ignored the 1993 legislation that ended the 9.5 guarantees prospectively. I further expressed my concern that if this transfer and recycle process were permitted, there was no limit to what could be created if secondary markets used the process over and over on the same old bonds. Even though one part of the department was asking me for information, another part was denying me any information on 9.5 payments. Even though the taxpayer payments are public information, the Federal Student Aid Office would not respond to my request for data. All during this time, I continued to press the Office of Ethics for more information about what I could do and could not do with the information I had. They suggested I take it up with the Office of Special Counsel, the agency for so-called whistleblowers. I talked to that office, but decided not to become one of their whistleblowers because even if I succeeded in persuading them that there was a problem, the remedy would be only to report it to the Secretary. For all I knew and still know, the problem at the department was at the highest levels. The Office of Ethics finally shared with me the provisions of the Lloyd-La Follette Act, which states that federal employees may share whatever they want to with members of Congress, its agencies, and employees. In the spring of 2004, I started making arrangements with Hill staff to get 9.5 payout information from the department and to send it to me at home, to my home computer. The analysis I did eventually was used in the paper Money for Nothing, published in August of 2004 by the Institute for Access and Success, authored by Bob Shireman and James Quall. That analytical paper was widely reported in the New York Times and many other papers around the country. Newspaper editorial pages all over the country condemned the situation and called for a cutoff of 9.5 loan growth. In September 2004, GAO came out with its report, which took pointed exception to the way the Department of Education was handling matters and suggested in its title that billions of taxpayer dollars were at stake. Congress cut off part of the future 9.5 loan growth in October 2004. In May 2005, the Inspector General concluded his audit of the New Mexico agency, asking that up to $35 million be returned to taxpayers. The Secretary overruled 2 of the IG's findings. A third finding was not at issue, and New Mexico returned over $600,000 for claiming a 9.5% return on a bond I had identified to the IG in August of 2003. In December of 2005, the IG reported to Congress that the Secretary was wrong and proceeded with its audit of Nelnet. That audit is now in its final stage and will soon be presented to Secretary Spellings for action. So that is the story I was invited here to tell. Let me add a remark by going back to those 4 reports that show U.S. higher education in trouble. Where was the Department of Education in the years 2001 to 2004? Telling researchers that they could not look into issues. That's where the department was. I had several efforts underway, all of which were quashed. With the new Spellings Commission, I hope that all of that has changed and that we are going to see further progress in American higher education as this report becomes available and as the Secretary acts on the new audits. Thank you, Michael.
Two things I want to emphasize. One, John said, one he did not say, probably because he's modest. The first is that there's this Inspector General report's coming out, presumably within the next 2 weeks or so, we have been told at the New America Foundation. The second is when Congress acted in October of 2004 to cut off the 9.5% guarantee prospectively, that in sum that has saved taxpayers, according to the Congressional Budget Office, in excess of $2 billion over the next 10 years. And this man is really the man to thank for that, at least by U.S. taxpayers. Let's hear from Raza Khan next.
Hi, and I apologize for being late. The reason we were actually running a little bit late today was we had a call with our counsel regarding a federal loan that a school is currently refusing to certify. And as we are still in the loan season, these are some of the things that we're still dealing with when we're interacting with schools. So I'll give you guys a bit of a background on our company, what we have been doing, how long we've been in this space and our experiences, and what we think is problematic about student lending. And we do think there's a lot that is very problematic with student lending. We had started several years back with a very different concept for financing education that ultimately led us down into the student loan market, where we had looked at the market and had assumed for several years it was an extremely efficient market, that there were a large number of incumbent players, all of whom were competing for substantial market share, and therefore what room in the marketplace was there for us. And gradually we realized how naive we were about student lending. So last year was the first year that we began issuing student loans on May 11th, and we were issuing private student loans. And we had begun a process in 2004 of talking to schools. The general understanding that we had had was that schools were an extremely influential party in deciding the distribution of student loans, private student loans as well as federal student loans. We had heard of cases where certain companies had started a direct-to-consumer program or were originating loans bypassing the financial aid office, but that most of those companies had ultimately failed. which we couldn't understand because most markets, whether it's financial services, computers, direct to consumer seems to always be the most efficient way. So it took us a while to really digest what was happening. In 2004, we attended a conference of financial aid administrators where we presented ourselves and said, we are in the process of launching a private loan product, and this private loan product will typically be 10 to 20% cheaper than what we have garnered to be the rates of interest provided by our competitors. On the assumption and the wide-eyed assumption that schools would be delighted, and they would say, welcome to our preferred lender list for providing the most competitive option. We were quite surprised that our placement rate on preferred lender lists for making such an offer was exactly 0. We were placed on exactly 0 preferred lender lists, even though at that point in time, benchmarking to 1 or 2 primary large originators for private student loans, our interest rate margins were approximately half a percentage point to 2 percentage points cheaper, and in origination fees, we were approximately 6.5 to 11 percentage points cheaper. So it was quite surprising for us. The common responses that we had heard from schools was, well, we think that's great, but what we want to understand is how are you going to certify the loan? Are you capable of certifying your loans electronically through our systems? So we scratched our heads and says, well, we're new to this industry. Let's go build this certification system that these financial aid administrators want. And when it's built, they will come, right? And that was the idea. So we invested, I don't know, approximately $1 million of technology towards building certification software that interfaced with school disbursement systems. And the idea was that now we have this very competitive private loan product, and we have this electronic certification system that you wanted us to build, so we would like to be on your preferred lender list. This approach also resulted in exactly 0 placements on preferred lender lists. So we started scratching our heads and saying, well, there are 2 ways we can go. We have been in this industry with a different product working away, and we think we have some real innovation that we can bring, and there are a lot of market inefficiencies. Do we want to shut down the business, or do we want to develop another way around? And I think this is where Michael, who's described us as Maverick, I don't know that we've ever described ourselves as Maverick. So last year we sat down and said, well, the schools ultimately perpetuate the myth that federal loans are, because a commodity item, that they are priced uniformly the same from regardless of originator. Therefore, the basis of competition should in fact be the services provided to schools. So schools prefer lenders who provide placements or electronic funds disbursement through a particular guarantee agency, which is the issue that we were facing this morning. They prefer lenders who offer administrative support, technology services, anything that ultimately seems to streamline the administrative processes of the financial aid office. And what we recognized was that there was no way that we were in fact going to begin a process by which we were going to accommodate every need of the university, and then of course still be 0 on 0 preferred lender lists. So the decision was, why don't we demonstrate that federal loans are in fact a commodity item, and the primary basis of competition for most commodity items is in fact price. So why don't we originate a set of federal loans and cut interest rate margins? In fact, let's cut profitability on federal loans to such an extent that competitors will not be able to match rates, and further, schools will be placed in an awkward position of having to explain why we are not on any of their preferred lender lists. And that is where our advertising comes into place. What we had published in the New York Times, and this list is also available on our website, are a series of questions that we recommended students ask. And the questions are very straightforward. Ask your financial aid office, can you guarantee the best interest rate? Reasonable question. I think in most consumer finance products, I don't know anybody who goes out and says, I'm interested in paying more on the loan because of services provided by the lender to my mortgage broker that lets my mortgage broker go home at 4 o'clock. It doesn't seem to be a factor that I'm interested in. I'm much more interested in the idea that I'm going to get a lower interest rate on the loan. So we'd also asked or recommended that students ask other questions to cite much more specific examples that occur at schools. And this will sort of go into some of the, some with respect to federal loans and some with respect to private loans, where schools are engaged in practices that are clearly anti-competitive. Now, what I have here, and unfortunately I can't show you, but anybody who wants to see it later, we can do a web demonstration. But what we had gone back and done was looked at the history of federal lending. And if you bear with me, I'll take you back to 1965. So back in 65, there was this government reaction to the war on poverty, so to speak, and also communism. And the concept was if we were going to win these two battles, we are going to do so through education. Therefore, why don't we provide an incentive to federal lenders or to banks that are not interested in lending to students by guaranteeing federal loans? And therefore, they will lend money to these students. These students will then be able to attend college. And what we need is the financial aid office to be in the middle, because we're the government. We're not going to know if this student is in fact enrolled at the school or not. So the financial aid office, the original job, the original market efficient job of the financial aid office was in fact to receive a loan request from a lender and based on that application determine that the student is in fact enrolled and how much the student is eligible for based on all their financial aid options. Schools eventually became this basis of control. What the school was able to do was say, well, we only work with certain lenders because these lenders make it operationally easy for us. And over time, this stretched to the extent that the school actually now is limiting the supply of lenders. And that's an odd term, but let me explain. Let's assume that you have 5 lenders who are interested in lending $1 million, and a school is interested in getting $1 million for its students. This will be a market-efficient scenario where the 5 lenders will have to compete amongst each other for that market share. And if they all compete equally, they should all, in theory, get 20% market share at the school. However, if a school is faced with the option of 500 lenders, but in fact goes out and limits the preferred lenders to 5, it is now reducing the supply of available capital to students. And therefore, those 5 lenders on that list will have an unfair advantage. In having that unfair advantage, they're able to do some of which was discussed earlier, but effectively they're able to keep price at abnormally high rates. There's no market pressure that says, I'm going to cut the origination fee on the loan, I'm going to cut interest rate margins on the loan, and further, once that value has been competed away, I'm going to compete based on customer service to the school, and when that value is competed away, I'm also going to compete for customer service to the schools, to the schools beyond the students. So had the schools not actually interfered in this process, we would have a much more efficient marketplace today for federal lending, but what we have, and I look at it with quite astonishment, incumbent players, people who I compete with, companies that I compete with, that make hundreds of millions of dollars in net income on federal loans, and in fact, control distribution. We did a statistical analysis, and that's one of the things I wanted to be able to show you all, of different schools around the country, where we looked at the average market share that lenders have nationwide, the average market share those lenders have in particular states, and then we looked for cases where they had abnormal market control at a particular institution. Surprisingly, it takes not more than 1 or 2 lenders to all of a sudden control more than 60, 70, 80, 90, 97% of volume at a particular institution. And these are large schools. University of Chicago, New York University, University of Miami, Stanford, University of Virginia. Schools that we all associate with brand name quality educations, yet there is an abnormal distribution of lender control at these schools. Our perspective in looking at this scenario is raising the question of where should this marketplace ultimately go, and what are the practices that need to be stopped. We have recently, I don't know if any of you have seen the letter, but we were recently banned from the National Association of Financial Aid Administrators. And this is not something that upset us. I have the letter from Dallas Martin framed in my office. It was interesting for us because we looked at the NASFA monograph. And NASFA publishes a monograph, and in this monograph, one of them covers the subject of preferred lender lists. How do you create a preferred lender list? In this monograph, price is mentioned exactly 0 times. Services to schools is mentioned at least 10 times. And at the end, there's a factor weight that they assign to the lender selection process. This is quite fascinating. Things like electronic disbursement and the ability to disperse electronically, they value at 20 points out of a scale of 25. The ability to certify through the school systems, they value at about 20 or 25 as well. And there's a whole range of these items that are all in the 20 to 25 range. When it comes to the discussion of repayment incentives for borrowers, that scores a 9. Upfront fees, I believe, scores a 5 or a 6 in the lender selection process. Now, NASFA can argue, and anyone can argue that, well, though these are just guidelines and schools are free to construct their preferred lender lists however they want, this is a true statement. However, the guidance that's there, the statistical data that we're seeing, and our own experiences of going to the school with a market competitive rate and being refused shows us as a company that this distribution channel doesn't work. And Citibank is very clear in their annual report in citing the role that financial aid administrators play with respect to distribution. And we've seen that played through time and time again. Where we think the industry should go? I've got 60 seconds. Where do we think the industry should go? We think the financial aid office, perhaps in the time when computing wasn't available, was successful in administrating a regional program because the government could not. However, where technology is today, there's nothing that says the financial aid office should do anything other than certify a loan. And in fact, it should do nothing to stem the supply of lenders in the federal loan market because it's a commodity item. Let us all follow the Department of Education guidelines for origination of federal loans, and let us market to consumers, and ultimately the consumers will select the best price options for them, and the school will certify the loan. And there's no need to interfere in the lender selection process at all. There's no reason that Georgia Institute of Technology, for example, will send an email to every one of our customers saying that they should go to Citibank instead. Or that another university should actually call students and say, you must choose one of these 5 lenders. And in fact, all 5 lenders are private label Sallie Mae lenders. So it's really one lender that they're recommending. And so those are examples of where we think the market is going. With the cross-sale value of private loans, which is the growth side of the market, as well as other consumer credit products and other financial products, federal lending now has been leveraged in so many ways that Sallie Mae is one of the largest consumer finance companies in the world with a mortgage product, with an auto product, I believe. They also have a career site, and we all know about their debt management operations, which is a great value driver for them, and they've recently started doing collections work for the IRS. So I think that federal lending has been quite good to these lenders, and I think we should see some competition. Thanks.
Thank you, Raza. Doug, I had to drag Doug Letterman kicking and screaming to this event, so I'm going to let him sit and ask his questions and respond to the other two discussants, and then we'll move to a Q&A. Doug?
Thanks. Is this on? How about that? Better? Thanks, Michael. I wouldn't, kicking and screaming is a little strong, maybe a little arm twisting. I had actually urged Michael to get another lender up here, maybe somebody representing the more traditional lending industry. As a reporter, I tend to believe that there's value in debate, and that debate is typically best undertaken when both sides are at the table. As a reporter, I don't represent a side. I see the reporter's role as asking questions, and if Sallie Mae or somebody from the Education Finance Council was up here, I'd ask them the questions. Since they're not, some of them may be in the audience and may want to, I don't know if there's going to be time for questions, but hopefully they'll have a chance to ask these folks questions directly. I mean, I guess what I would like to focus on, a couple different things, maybe start with John. Can you talk a little bit about where the 9.5% issue stands now? I guess I don't consider myself an expert on the student loan programs. I'm a higher education journalist, and I've written about the loan programs, and I don't know how expert all of you are, but I think the key thing for me is sort of figuring out what the implications are for students and their families. A lot of the debt issues that John talked about are really prominent right now. But if you could talk a little bit about sort of where that issue stands, whether there is a stake has been put through the heart of the 9.5% interest rate at this point, and if either way, what the implications are, the sort of broader implications for federal policy making on student loans.
Yes, the current status of 9.5, Congress has enacted two measures. One, the Teacher Taxpayer Protection Act of 2004, and then also HERA, the bill that was passed in February of this year, that eliminates the three different ways that loan holders were growing 9.5% loans. So in that sense, the growth issue has been stopped by Congress. That leaves two other very important issues. One is, what about all that outstanding loan money on which we are paying 9.5? Can anything be done to get that back? I did not mention it in remarks, but in my communication to the department early on and in several other communications, I had advocated that the department simply contact borrowers who may not know that they have these loans that are so expensive to taxpayers and appeal to them to consolidate them, to get the country out from under these huge payments. I'm not sure why that was not done. I think a business would immediately try to get out from under high interest rates when it had the opportunity by calling bonds. This would be a good solution, but it has not been pursued. There was a bill put in the Senate that would do that, which would not only require the Secretary to do that, this was a couple years ago, but also put some sweeteners in and say to the effect, if you have one of these loans, we'll make it worth your while. Make it very simple for you, go on a web page, sign, and we'll knock a few hundred off of your balance for your trouble, and we'll all be ahead. That is still something that could be done because there are still a lot of 9.5 loans out there. The other thing that is going on is, of course, the audits of those that extended and grew the 9.5. And I did mention that the Nelnet audit, and Michael mentioned too, probably will be made final in the next 2 weeks. Maybe that's too soon, maybe in the next several weeks, but that is expected rather soon, and we will then see whether or not the audit exceptions will be enforced and some of that money will be returned.
What would be the reasons why, what is your sense of the reasons why the Secretary did not accept the recommendation, most of the recommendations in the New Mexico audit, and what if the IG comes out and finds Nelnet to have done the same thing and the Secretary does not accept them, what will be the explanation for that in your view?
Well, there are two different cases. New Mexico, first of all, didn't involve quite so much money, and New Mexico also didn't try to grow 9.5. Some of their violations were that they simply extended the bonds and did not realize that what they had to do was to keep the old pre-1993 bonds intact. That is, their bond genealogy was not correct. They had actually retired and defeased some of the bonds. But New Mexico did not try to consciously to grow the amount. Nelnet, on the other hand, we don't know what kind of bond genealogy problems might be there, but they multiplied their 9.5 holdings very aggressively, 8 or 9-fold. And that was an issue that was not in the New Mexico report.
Yeah, Raza, I guess my questions for you revolve around sort of the extent to which you can distance yourself from the rest of the industry. You work with some of the with like FIA and AES and that conduct some of the same that use some of the same practices. Where's the bright line between your company and others, and in what ways can you I mean, given some of those entanglements, in what ways can you claim to be different?
Excuse me, Raza. FIA and AES is one company. It's the Pennsylvania Higher Education Assistance Authority, American Education Services. It's a lender that originates loans. It also guarantees loans. It services loans.
In our scenario, I think we're definitely alone in the industry. Other than, I think we've received communications from people at other institutions, other lenders who've sent us emails saying, we think what you're doing is great, but then publicly they'll say something completely different. And so we've seen that experience played through in every industry inside our relationship. The role that AES plays in our organization, they are the largest originator or servicer of private and federal loans. So effectively for us, what we are always in is a tug of war with what we want to do and what we think the industry should be doing. And to make anything in this industry work, not only do we have to convince our capital markets providers that what we think is right, and they'll say, it doesn't make any sense, nobody's done this before. And then we'll say, well, we have to go to the rating agencies, and then we have to convince the rating agencies that their models for analyzing these loans are not the most advanced as to what they could be. So we have a process with the rating agencies where those are two major parties that we're working with all the time to convince them that what we want to do will in fact work. We also have to challenge our servicer. We're always asking them to update their mainframe system. At the current moment, AES is a strategic advantage for us because they also do all of the servicing for First Marblehead's private loans. So it makes it very easy for us in a securitization to say that this is the same as this is serviced the same way as First Marblehead's loans are, which is a large originator of private loans out there. And also with federal loans, they also have exceptional servicing status, which means that in the event of default, 99% is reinsured, is insured. So that's a real strategic advantage for us because we effectively have the same exceptional performance status as Citibank or some of the other large players out there. So those are the scenarios where it's advantageous for us. We're not using or working with AES in a marketing capacity. What we're really just focusing on is sort of a contract origination, contract servicing relationship. It's worked well for us so far, and we'll continue to evaluate what we think is the most efficient approach going forward for us at a given point in time.
Doug, one more? Sure. No, go ahead. No, you please.
When in response to some of your advertisements, it sounds like since you have the NASFA letter framed on your wall that you're not backing away from your criticisms of the financial aid community. But there's been some criticisms that you painted with a pretty broad brush and sort of planted the idea that this is what everybody's doing. Do you have a sense of how widespread and common some of the practices that you decry are, and do you think that you've left an impression that it's more widespread than it is?
Raza, 60 seconds. No, 60 seconds.
I need 2 minutes on this one. If I can barter something else, this is the one.
You were late, Raza.
So the broad brush argument is actually my favorite criticism. The reason why is I'm a big believer that exact numbers are the best adjectives. So if someone wants to argue to me that, well, you're painting the majority of the market this way and the majority of the market isn't that way, my question to them is, what's your definition of majority, right? If they say, well, some people do this, my question is, what do you quantify as some? The experiences that we've had have shown us that more financial aid administrators engage in different practices, in different ways of garnering anti-competitive behavior. But surprisingly, the question of painting someone with a broad brush is actually irrelevant here. I always use the example of somebody who's done something wrong, and you ask them, did you do something wrong? Our most vocal critics, when we started doing our statistical analysis, turned out to be the ones that were engaged in revenue share, that had a school as lender program where they were receiving revenue on their federal loans, where lender control was 80, 90% allocated to a single lender. So really the most vocal critics of the broad brush were those who were in fact engaging in some of these practices. All of the criticism came with this acknowledgement. Well, we know that this happens, but you shouldn't have said everyone did it, right? My argument is, how am I as a consumer supposed to know if I don't ask? And that's what that checklist did, is it gave consumers a series of questions to ask. And if you're not engaged in any of those practices, hey, it's the easiest checklist to say no to. No, I don't engage in revenue share. No, I don't receive kickbacks. No, I didn't get a $250 iPod at NASFA off the gift rack, which I was going to show you guys a photo of, right? No, I didn't participate at KeyBank's casino night at NASFA. So those are examples where individuals could simply come out and answer the questions and end all discussion.
Thank you, Raza. In exchange for your minute, I'm going to forego a question and turn it over to the audience since we're already running a little late. I ask that you please refrain from any sort of speechifying. If you have a question, offer the question. Please, no comments first, masquerading as questions. And if there is a speechifying, then someone will pull the microphone away. Why don't you just grab that? You guys can share. Okay, questions? Please raise your hands, otherwise I will ask. Yeah, you in the back?
Hi.
Can you please state, when anyone who's asking a question, can you please state your name and what organization you're with, if you're with an organization?
Peggy Ochowski. I'm a journalist in higher education, and I write for Hispanic Outlook on Higher Ed. And I've done some stories on Nelnet and this issue. But just to make it clear, because there's a lot of controversy between these kind of loans and the direct university loans, that these kind of loans are usurping what used to be considered better value direct university loans. Could you address that? And also, are these loans that are paying for Pell and Perkins grants? That's, I'm not sure where the intersections of those are. These loans that they're getting, they're not just student loans, are they? They're loans that are underwriting Pells, or is that true?
John, do you want to speak to this? Why don't you grab the microphone? John, Mike?
We could mix apples and oranges and all kinds of various grant and loan fruits here. And also the different kinds of processes by which Congress funds these various programs. Pell grants are so-called quasi-entitlements. They're funded from a different source than the loan program. They're a different process. Direct loans, that is a different issue. That is a split between, that is a choice of institutions as to whether they want to participate in the direct loan program or in the FFEL program. I would note that there are several analyses out, 3 of which are from government agencies, CBO, OMB, and GAO, that show that the direct loan program saves a lot more than the FFEL program, which is the one that we're talking about with regard to the 9.5 program. Those haven't been the discussion points today. We've been examining, or at least I have, just that one aspect, the 9.5. Of course, it is a good question. Why are we spending all of that money? Could it not be directed some way into programs that do students good. And one of my points was we don't seem to have a lot of research on our programs. We don't seem to have a lot of interest at the Department of Education, at least when I was there, in order to do that kind of research and find out what kinds of programs would be best to invest in.
Other questions? You in the blue sweater?
Kim Clark from U.S. News. Could you address the legality of the preferred lender list? You said that you had schools that were informing students that they couldn't borrow from you. Is that correct? And what is the law concerning that?
That's correct. The law states clearly that a school is not allowed to engage in a pattern or practice of discriminating against a student in his or her selection of lender. And so this is an example that's clearly illegal, and then we're working with different counsel to take the appropriate steps. It is important to acknowledge that the Department of Education has been absolutely lackadaisical about any of the problematic practices in this industry. So the schools are technically supposed to originate whatever or certify whatever loan the student selects, and that's really the extent of their responsibility.
Other questions? Gentleman in the back with the suit.
Jim Settles, Citizens Bank Education Finance Department. A couple of statements. First of all, for John, there also were some agencies that found that the FELP program was the cheaper way of funding education finance also.
Excuse me, sir, I'm happy to have this discussion, but I asked initially that we limit to questions as opposed to statements.
Okay, just a question. Well, that was, I guess, an aggressive question to John. I would just ask Raza. Raza, you have a sales force, and is your sales force, how large is your sales force? And has someone told your sales force that they would not accommodate the loans that you certify?
I didn't hear the tail end of that.
Someone in your sales force, because every school we know that always will tell a student that any lender you choose, we will certify that loan. And I'm saying that someone told you that they would not certify or accommodate a loan that you guys are offering.
We have students and parents.
Thank you.
We have scenarios where we have students and parents where there was a parent who had applied for a loan from us, and the loan had been replaced with the Student Loan Express, and the parent wasn't even told. And so the school had pushed a different application, and the parent was stunned. And there are cases where the students feel intimidated and strong-armed because the financial aid office insists, and the students are afraid to, in fact, challenge the financial aid office, thinking their future aid awards may, in fact, be affected. I also have a counter question for you. I believe you have 96% volume market share at Roosevelt University, and I'd like to know how that is.
I don't want to get into a debate here, Raza. And I also, want to be fair. There's a long-standing and heated disagreement as to whether or not the direct loan program, which John mentioned, or the Federal Family Education Loan Program, which Raza participates in Citizen Bank and a lot of people in this room, which one of these two programs is cheaper for taxpayers. The government studies John's mentioned said that the direct loan program is cheaper. There are other studies. America's Student Loan Providers, which is a group that is a coalition of lenders, has put out studies. PricewaterhouseCoopers, which has also put out a report and I believe was financed by America's Student Loan Providers, has put out studies arguing the other position. And I encourage you to take a look at Sally May's materials or America's Student Loan Providers with respect to the relative taxpayer costs of these two programs. Are there other questions? Yes, ma'am, you in the front. Ma'am, you in the front. Wait for the mic.
This question is for Raza. The question is, can you give us any specific names of companies you believe are in violation of the prohibited inducement rules?
Not at this time, but we are pursuing different legal avenues to protect the students' rights who have worked with us.
Okay, thank you.
Other questions? You in the front?
Hi, I'm Alexander Konetsky. I work here at the New America Foundation. My question is for you, Raza, as well. I was interested in this third question that you provide for students to ask, specifically about revenue sharing and kickbacks. I want some more specifics. I was wondering if you can provide them about kickbacks, namely which schools are getting the kickbacks, how much are they getting, and who's giving them those kickbacks.
Well, there are two forms of revenue sharing, and I'll try to contain it within the FELP because I think most of our conversation is about FELP, but there are kickbacks on private loans that are resulting in higher rates of interest for students. So that focuses more on the private loans. Then there is the school as lender model. And I think the school as lender model is patently the most absurd thing I've ever heard of. A school acts as a marketing front end. The loan is originated by a FELP lender, and then the school receives fee income of 3 to maybe 6 or 9% on the principal balance funded, which is a fair amount of capital. The capital then sometimes is used to reduce the origination fees of borrowers, and in some cases then it's further used to just create scholarships for other students, which of course raises the question, why single out a particular subset of students who are already having a difficult time paying for education to create scholarships for other students, which ultimately serves the school in its ability to procure more revenue through tuition dollars. Finally, if the school would simply disintermediate itself and allow the student to go to the lender and ask for a reduction in the origination fee, this would be called something surprisingly new, a discount.
We're going to have two more questions. I want to mention one point about school as lender. The school as lender program also exists in another form called eligible lender trustee. In the Higher Education Reconciliation Act, Congress clamped down on school as lender. New school as lender schools cannot join the program as of July 1st of this year, and all revenue gained from school as lender programs has to be used for need-based supplemental financial aid. Previously, it didn't have to be used for scholarships. It could be used for anything. Okay, we're going to have two more questions. Jeff?
So we've been, one of the lenders that actually agrees with you on introducing competition into the marketplace. One of the problems I see, and want to get your reaction to, is do you think part of the problem is that everybody has their own technology platform, and once a school kind of sets up its operation, it's very difficult to use other lenders if they don't use that technology platform?
Thank you.
Actually, to answer this in a completely different perspective, the federal loan program is a privilege for the university. If I were to start a university today, I'm going to look to get Title IV status so I can provide low-cost federal loans to my students.
Title IV of the Higher Education Act, which governs all financial aid.
So effectively, I'm going to do whatever it takes to meet the requirements of this loan program to maintain that privilege. Nothing in this loan program says I should be making my life easier. I, in fact, should be working to figure out how many different lenders I need to work with because of the lenders that my students are selecting. So the burden of responsibility, actually, to adapt is the schools in this instance. Otherwise, really, a lender could simply send a paper-based certification and a paper check, and the school would have to take it. We're not doing that, but I think it can go either way. But the school should realize that the burden of responsibility is actually theirs, not the lenders.
I'm going to ask the last question, I'm afraid, and this is to Raza. Raza, you have suggested that financial aid officers should, in effect, no longer play a informed intermediary function. Some private lenders have been very successful in getting around, frankly, preferred federal student loans. They've encouraged borrowers to seek them out for quick loans that are rapidly available, that cover more than tuition, even though these loans, private loans, are much more expensive for student borrowers, even though federal student loans cover much more than just tuition and fees, and even though federal student loans can be made available to an institution very rapidly. If the informed intermediary function is removed from the financial aid office at schools, will students be taken advantage of who otherwise may not be as sophisticated financial consumers as maybe you were when you were attending school?
I don't think that that's the case. A lot of it has to do with how federal loans are marketed, and we're about to introduce some changes to the ways we're advertising federal loans. First, I think any attempt to encourage students to just simply circumvent the process and get a private loan is probably not a wise idea. Federal loans do cover enough of a percentage of the cost of education that it's worth the extra effort, if there is extra effort. I don't think there needs to be in getting sort of the lower cost prices. There is a risk. I think that certain lenders will go out and market that you don't need to do this, but the law of market says if I'm going out there and marketing a lower cost option, the next person who's going to come out is going to try to mimic what I'm doing and doing it better. So the general trend should be that consumers will find the best options anyway. I use this example always that $1.7 trillion of mortgages were originated without a single financial aid office.
All right, thank you very much. I want to also take a moment and thank the Pew Charitable Trust, which is funding New America Foundation's higher education work with respect to student loans. They don't endorse anything that's been said here today. They're simply providing resources in order for us to get out information. New America has a new website, newamerica.net, which I encourage you to take a look at. And the Education Policy Program also has a new website, higheredwatch.org, higheredwatch.org. On there, you'll find out more information about the issues discussed today, as well as our new blog, Higher Ed Watch. And lastly, the New America Foundation also has an associate director position available with respect to the Education Policy Program. There's information available about that outside in the hall on the table, and there will be more on the web should you visit later today. Thank you for coming.